Hello there, my name is John Mungai and today we are going to talk about treasury bonds. By the end of this video, you are going to know what are treasury bonds, who issues the treasury bonds, and why should you or would you buy them, and most importantly, how do we make money from the treasury bonds?
Sure, it is Money Matters in your favorite investment and financial planning YouTube channel, Quenching Your Thirst, as directed by Willis Nyakundi. If you haven't subscribed yet, then this is the moment you did so as not to miss future videos. Back to our financial advisor, John Mungai. So, what are treasury bonds?
Bonds or treasury bonds are a form of loans that are issued by a government or a company when they are in need of money. A government is like a business. And like a business, all businesses needs to make money. So what happens when a government wants to do something, but it doesn't have enough money to do it? It goes on to the citizens and it uses this form of debt or loan to get money. Bonds are like stocks. The way you go and buy stocks of a company and you sell them to make profits, or the stocks give you dividends when they earn profits in the company. That's how bonds are, but the difference comes in they have a plan on how you get your money back, and they have some terms such as the amount of interest, the day you get your payment back, and so on and so forth. Whereas when you go and buy a stock, you can sell it immediately. A bond, it has a period of which you cannot be able to get your money back until the maturity date of that bond. There are three kinds of bonds. Number one is called the infrastructure bond, otherwise known as IFB. Number two, there is the fixed interest bond, known as FXD. And then lastly, there is the corporate bonds, which are issued by corporate organizations or private organizations or agencies. The FXD is commonly a taxed bond, or the government has to tax you on the interest that you gain. Whereas the infrastructure one, you are not taxed. It is called the tax-free bond, because that money that the government gets from it is used to build the roads, hospitals, and schools, and so on and so forth. So the government issues bonds or treasury bonds every month in what is called an auction. And what you need to look out for when you're going for that auction is, number one, the type of bond, number two, the duration of the bond, and number three, the coupon or the interest paid. Different bonds have a different duration. For treasury bond, the duration runs or ranges from 2 years to 30 years. So you can find a bond that lasts for 2 years, 5 years, 10 years, 15, 20, 25, and 30. That's how it is. You'll never find a bond of 7 years. They run from 2 and then goes to 5, 10, 15, 20, 25, and 30. There's not been any over 30. Now, when you want to invest in a fixed interest bond, the minimum amount you can pay is 50,000 Kenya shillings. And if you want to top up, let's say you have an extra amount of cash and you don't want to keep it lying around in the banks or hide it under your bed, you can top up. And the amount to be topped up is multiples of 50,000 Kenya shillings. What do I mean by that? It means that after you paid the 50,000 shillings, the minimum, and you want to add, you cannot add anywhere below 50,000 Kenya shillings. When you want to buy an IFB, infrastructure bond, which is tax-free, you pay a minimum of 100,000 Kenya shillings. And if you want to top up, the same case, a multiple of 50,000 Kenya shillings. I hope you get that. The government has coupon or interest in the bond that we have bought. Let's use an example of a bond that has an interest rate of 10% per annum. FXD bond. Let's use an infrastructure bond, IFB bond. So an IFB bond that has been auctioned for 100,000 Kenya shillings, which has an interest of 10% per annum, meaning that every year you're going to get 10% interest on the amount of money you bought the bond at, which is 10,000 Kenya shillings. So the government will pay you every year 10,000 Kenya shillings. Let's say the duration of that bond is, let's say, 5 years. Let's use 5 years. So for those 5 years, every year you're going to receive 10,000 Kenya shillings from the government. But here is the caveat. In Kenya, the government pays you in two halves. The two bonds, as I've said, the FXD and the IFB, the FXD is a taxed bond, but while the infrastructure one is not taxed. For every bond that is below 10 years, the duration of the bond, it will be taxed 15% on the interest. So on these 10,000 shillings that is supposed to be given to you, that's where the government will tax, and it will tax 15% of 10,000 Kenya shillings. If the bond is above 10 years, it will be taxed 10%. So 10% of that 10,000 Kenya shillings. Give to Caesar what belongs to Caesar. That's how it is. Even the Bible says it, and we can do nothing about it. If you are interested in having an investment that is very low risk, I would suggest that you go and invest in treasury bonds. This is one of the best investments that you can make. Instead of letting your money lie down or sleep on the bank, being affected by inflation and other things that will make it lose value, it is better to invest it in the treasury bonds, which will make you a better investment and make you a bit of some money as you wait to find something else worthwhile. Remember, at the end of the maturity date, the government will return your full amount. Treasury bonds are some of the lowest risk investments there are in Kenya. When you compare to others like stocks, remember, when you invest in stocks, stocks are affected by the stability of a company. But when it comes to bonds or treasury bonds, if you invested 100,000 Kenya shillings and the government assured you that you will get a coupon of 10%, it means whatever happens, comes rain, comes sunshine, the government will be paying you every year 10%, which is a good deal, which is a very lucrative and very attractive investment deal for you out there. Now, another thing, when investing in treasury bonds, the good thing about it, it is secure because it is backed by the government. When you invest in other companies, the companies might fall, might collapse, the members of the company might steal the money, and so on and so forth. But when you're dealing with the government, when the government tells you it will pay you this amount, it will pay you that amount. Not unless something happens and the government is overthrown or something happens. or something tyrannical happens, which I doubt can happen, but you never know. So those are some of the advantages and maybe some disadvantages of the treasury bond. One term that you're going to come across is something called the face value. So what is the face value? So face value is the amount of money which the bond is worth at or during the maturity date. This is the money when the duration of that bond ends, the money that they will give you, that is called face value. That's the money you will get after the bond date ends. The coupon dates. So coupon dates are the dates which the interest are going to be paid. I've said in Kenya they paid in two halves. They pay you interest in two halves. Let's say you made an interest of 10,000 Kenya shillings. They will pay you 5,000 after on the first 6 months, and then the other 5,000 on the remaining 6 months. Maturity date is the end of the bond, meaning after that date, the bond will cease to exist. So those are some of the terms that I believe you are going to come across when you are investing in treasury bonds. I hope I have enlightened you, and I hope you are going to make wiser decisions when it comes to investments. Thank you and have a nice day.
Perfect and simple to understand presentation it has been. We believe you are adequately equipped to try this form of investment. Remember to like, comment and share, and if you haven't subscribed yet, we will appreciate that noble gesture. Cheers!